Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly review, this time for the week ending September 22nd, 2023. Let's start with a look at this week's markets after 4 days. Lots of red on the screen here. A few things, the TSX underperformed. We had a higher inflation print in the country here, weighed on the TSX, but also we had the Fed this week, which is committed to the higher for longer message. It's been a message they've been pushing for a while. The Fed, the Bank of Canada, the ECB, most major central banks have been pushing this message. Markets have not seemed to listen to this message for a good while, but now it seems like these words are starting to be heard, and the markets are getting more nervous about the prospects for having a harder landing than expected because interest rates remain high for a while. And just put it another way, if interest rates remain high, as central banks are suggesting, then it's hard to have a very constructive economic scenario. In 2024, we should have a slowdown that could be more significant, let's say, than what the markets are expecting. And any scenario where interest rates start to fall in 2024, central banks are preemptively cutting rates, is one where the economy deteriorates quicker than the market is expecting. So there's no way around it. So this is what's behind, it seems at least, the negative performance of risk assets this week. Interest rates higher, so bonds suffering, oil lower, gold lower, CAD and euro higher versus the USD. So the story in Canada this week was inflation rebounding to 4%. That was steeper than what was expected. Let's dig into the details here to show what's going on. First, when you always look at the monthly, at the annual rate of inflation, but let's look at the monthly rate of inflation here on the left. You see it's been sticky at an elevated level pretty much every single month this year. And if you want to have 2% inflation on an annual basis, if you want to reach that target, you need to see monthly prints that are on average slightly below 0.2%. So 2% annualized means 0.2 or a little bit less than that on a monthly basis. And as you can see, we're far above that pretty much every single month since the beginning of the year. And that allows us to forecast in the future what the annual rate will look like, because you can have an idea of the dynamics. And remember, early this year, we're looking at the chart on the right, which was suggesting that we would see a trough somewhere in the summer and then followed by a rebound, where we are in the rebound right now. And if we continue to have prints like this of 0.3, 0.4, 0.5, and even higher than that on a monthly basis, that means that now we're going all the way to June 2024 on this chart on the right. Inflation could be sticky above target all the way until summer of 2024. So it would take a sharp slowdown in monthly prints on average until until June 2024 to see inflation back on target. So likely inflation will remain above target for a while, unless we have something happening, maybe an economic slowdown that's worse than expected, taking inflation down a few notches. But the base case scenario, I would say, is that inflation sticks around for at least another 9 months here. And the inflation in food, inflation in rent, inflation in gasoline prices, those are all factors that are very important here. Gasoline prices, it's a global market, so anything can happen there. OPEC Plus could change their views and you can have volatility there. But things that are a bit more stable and still elevated are here on this chart. Here on the left you have food, and on the right you have rent. And on the left, it's food is more of a global market, lots to do with climate change. Inflation remains elevated, and as you can see, it moves slowly. On the right, it's rents, mostly because of population growth and higher interest rates. So these two factors are not really going away. And again, if you have to pay more at the grocery store, you have to pay more for rent. Well, that means that there's less money left in the budget for anything else. And this is how inflation takes a bite out of growth, out of consumption. And this is how it slows the economy down. So again, the inflation picture is we made some good progress, but now we remain in the part where central banks looking at that, what they need to do is to keep rates high for longer. It will create economic damage, but this is how you win the fight against inflation. Now talking maybe about the Fed. The Fed skipped a turn, no hikes this month. But they are committed to the higher for longer narrative. So Mr. Powell said a few interesting things. They're going to move slowly now to get inflation back down. Doesn't mean that they're done hiking. They're pretty much at the end. There might be one more hike or two, but we're at the end of the cycle. Mr. Powell said that they want to see more consistent progress with inflation in the labor market. And as you can see the caption also, real interest rates, so interest rates minus inflation, which is the economic measure of the weight of inflation of interest rates on economic activity, are meaningfully positive, which is restrictive on an economic sense. So the dot plot that they published every 2 meetings, they publish their forecast, had a very interesting message, and this is where we were focused, and this is what we were looking for when we're waiting for the documents to come out, is what were they looking for in 2023 and 2024. And here these are all of the forecasts of the members of the FOMC committee by the end of years. And 2023, one more hike remains the base case, or at least the consensus from these members. But 2024 was in focus, and this summer the last forecasts showed that they were expecting 4 cuts in 2024, 100 basis points, and now they cut that in half to 50 basis points. So they're looking like they're expecting that the economic conditions, the market conditions, will not be supportive to cutting as much as before, which is a pretty hawkish message, and it was received by the markets with the picture that we showed at first. So what to watch next week? We'll have July GDP in Canada. We'll have the Conference Board Consumer Confidence Index in the US. Revision to Q2 GDP growth should be revised a bit higher. What 2.1, now it's going to be 2.3 according to consensus. So let's see. And core PC inflation, which is a favorite inflation measure from the Fed, should be a bit lower than last month, but still high at 3.9% in August. So that wraps it up for the week. ia.ca/economy, iagam.ca/insights, and find lots of material there. Always a pleasure to serve you. I'll be back again next week.